Hi, I'm Kevin McParland, Head of Market Structure and Technology Research here at Coalition Greenwich. I'm here with my colleague, Michael Turner, who is the Head of Competitor Analytics. Mike, how are you?
Doing very well, thank you, Kevin. How are you?
Great, great. Good to talk today. So the data is in for the full year of 2021, looking at performance of the large investment banks around the world. They had a banner year in 2020. We all know that by now. And they seem to have managed to still increase revenues in 2021, although the contributions from the different businesses changed. So can you talk us a little bit through that evolution, sort of which businesses did well, which ones struggled, and why?
Of course. So if we think about full year 20, the pandemic hit, it was huge volatility that led to very strong gains in some of the trading products. And then governments around the world responded. There was huge changes in fiscal and monetary policy. And that really fed into some of these booms we saw in full year 21. So the main growths were in IBD, so in particular ECM, M&A. We saw the SPAC boom, which obviously in 1Q22 went away, which is why we're seeing some of those products down 80% this quarter. Equities also did very well, whether you exclude or include Archegos. So obviously Archegos was a $10 billion drag, but if you exclude that, equities was still up 20, 25% or 5% with a $10 billion loss in it. High levels of index, re-emergence of some of the quant funds back into the market. And at the same time, with some of the lower kind of funding charges out there, we saw a big boom in some of the spread financing products. So securitization, warehousing, middle market financing, structured credit, all of those products did very well. And probably the only drag on the system was the macro products, whether it was rates, FX trading, some of those in the low vol environment, client volumes went away. They normalized basically back down to full year 19 levels. So when you compare 21 versus 19, most of macro is flat to slightly up. So the growth we really saw came from that spread, equities, and IBD products.
So let me dive into equities a little bit first. So
Sure.
did the meme stock sort of boom in the beginning of 2021? Did that have a positive impact at the institutional level, both for cash equities and for options?
Yeah, so it happened both in 1Q21 and followed through, so much so that actually the US retail structured product market, for probably the first time in a decade, or if not longer, was bigger than the European market. So that whole side and that retail engagement, that hunt for yield, the tech stock kind of heat led that the American structured derivative market really boomed, as well as that cash equities trading side. The cash equities side was only probably up about 10% overall, whereas the exotic derivatives was up almost 90%. So the boom really happened on those derivatives side. Flow EQD was down. That was because that really benefits from volatility, and the volatility was huge back in full year 20 at the height of the pandemic. So it was a bit of a normalization on the vanilla side. What really grew was some of those retail structured products, exotic options on that end.
It'd be interesting to see if that continues this year. And then so on the fixed income side, again, 2020, busy year, incredible volume numbers, corporate bonds, government bonds. 2021, low volatility, low turnover. Obviously, there's been a sort of a pushback on profit margins in some of those flow products in fixed income anyway. What else are we missing there? Like, what other trends were there in fixed income?
So I think one of the ones we really saw was also the emergence of a lot more liquidity into the system with low margins. So repo was really hurt because there was just so much cash around. But where that was really directed was into this less liquid credit. So the warehousing, financing, CLO, some of all of that area was some of the areas that grew. And I think you touched on it in your comment before about will that continue in full year 22? We've seen full year 22 with the outbreak of war. It's almost a repeat of full year 20 again. So vol has come back, clients are looking to manage their positions, and we've seen spread products. So some of these things that have grown, especially on the trading end, so agency RMBS, high yield credit, those are down 30, 40, 50% year on year in 1Q22. However, that warehousing private financing I keep talking about, that has actually remained relatively robust in 1Q22. So there's still a lot of opportunity out there for connecting investors and issuers. And the real winners here, I think, are that sponsor investor community that are having the best of both worlds from financing side and the connection to some of these interesting assets.
That's really interesting. Yeah, I mean, why don't we take that to go into the first quarter of this year? A lot of volatility in a lot of markets, and some of the data that we've looked at really has made it feel like the volatility was bad, right? Where people were sitting on their hands and a little bit nervous. But where there's, I mean, obviously commodities have been hot. I mean, what does that look like from a bank revenue perspective?
Sure. So you're right that in certain areas it was almost bad vol. I would call out rates at that one. So the exotic end of rates, we saw some losses at some of the banks. But the lightly structured end, this vol was actually quite good for it. So vanilla options doing relatively well on the rates end. Where we've seen the growth has actually been in FX. So the FX volumes have been very strong, but also the margins have been, the spreads have been better, margins are better. And that's led to most G10 FX and EMFX dealers being up 20 to 50%. And so when you roll that through and you look at all of the banks that have reported, you can see the banks that are very macro heavy, so especially some of the Europeans and British banks are doing relatively well in this environment because they're more macro weighted, whereas some of the Americans that are more spread, securitization, high yield flow credit trading, doing much worse and having that drag. And then to top it all off, as you pointed out, is commodities. Energy related, ags, oil, all doing incredibly well. And we've got it up about 30% in commodities. And if you remember in 1Q21, we had the Texan freeze where many of the US banks made significant sums on that huge breakdown in the US power market. So it's 30% up, probably what was a decade level event in US P&G market.
Yeah, interesting. So what about on the investment banking side? Obviously, the deal boom of the last 2 years has been pretty incredible. I know there was some really good corporate bond issuance in the first quarter, but how did that look at sort of globally?
Sure. So I think the real story in IBD was the normalization in ECM. We had SPACs last year. We've also seen a drop off in IPO given the volatility. So most dealers are down 80%, some of them even more who were big on the SPAC side. And when you think about it, in comparison, we've kind of reverted back down to the pre-crisis levels in a massive bump. Whereas M&A, you'll have seen that most of the banks on the revenue side were up 15 to 30%. That's largely through deal completions that were announced in the second half of last year. If you actually looked at deals announced in this year, they're down 30 to 50%. So what we're seeing is as that 2Q, 3Q quarters come up, we're probably going to see a slowdown in some of those M&A revenues, given there's much less in the pipeline. Maybe some of those are more paused and they come back. It really depends how the war ends and whether investor confidence comes back or there's a significant investment in defense or ESG or energy security that could provide some boost to that market as well. And then on the DCM side, as you said, the challenge has been about what happens in a rising rate environment. What does that do to the loan side and the leverage side? I think it's still a bit early to see. I still think in the general history, money's still quite cheap. There's still not necessarily a credit event, and there's a lot of refinancing needs. The DCM should stay, compared to pre-crisis, at relatively robust levels.
Yeah. I mean, obviously, we were working off of a very high bar that was set over the last 2 years as well. So anything by comparison will be tough to match up, but a lot of to be determined. So one last thing to dig into, interesting in the data, right? You look at the head count amongst the big banks. It looks like it's remained relatively flat over the last 3 years, which I think comes after a period of a lot of sort of tech investment that has saw some headcount decline. Anything else interesting in the headcount data worth pointing out?
So I think what we've really seen has been, if we roll back to the GFC, there was a lot of headcount takeout as revenues dropped, a lot of investment in those platforms that you talked to. Most of those headcount has largely been taken out now in 2019. We've hit that peak where you have that minimum amount of sales and traders in general to service the business. And then what we saw then in the markets and trading side over the last 2 years is that revenue per head has grown between 20 and 50% depending on the product. So there's been some real gains on the productivity side. However, what we did see was a real exodus of talent to the buy side. So the biggest challenge has actually been keep banks retaining their talent and their star traders and star salespeople, because the buy side have been very active there over the last 12 to 18 months. But that has been offset by, as I'm sure has been very well publicized, large hiring sprees on the IBD side. So to keep up with some of that activity, we've seen huge booms in recruitment on the investment banking end. The question for me is, given everything we're seeing in 1Q22 in banking, is all those new heads, are they going to have enough work to keep them busy, or will they'll just have more normal working hours for a change?
Yeah, interesting. Yeah, normal market forces usually keep that in equilibrium over the long term, right? Money can often talk, as do other perks. Yeah, that will be very interesting to see. And clearly, right, it looks like what we've probably seen is an upgrade. The banks have had an upgrade of technology and people, right, that have added to a lot of those efficiency gains and ultimately profitability gains, which is what, of course, they were going for. Great. So yeah, I mean, I guess if we crystal ball like 2022 long term, I mean, there's so many unknowns this year, probably more than usual, but any expectations or things that you and the team are looking at for the next sort of 6-9 months?
Well, I think what we found really interesting in 1Q22 has been the balance of revenues. As spread has come down and cooled off, macro has done better and replaced some of those revenues. Even within equities, prime has held relatively robust as the exotic derivatives came away. So when we modeled some scenarios about a managed landing from some of the rate rises and the war, or a hard landing where we get a stagflationary environment, at the IB level, the revenues are broadly similar. They're within 5% of full year 2021, down, but within 5% of each other. And most of that comes because in an environment that's good for equities and spreads is probably quite bad for macro, and vice versa. And I think what we're actually seeing at the moment is that hard landing scenario is working out quite well for macro. It's being challenging for spread, and it's being challenging for IBD. But interestingly, equities and where we're seeing index values seem to have already switched to this managed landing one, where they're remaining high. There's not as much asset allocation away from equities. Maybe that happens for the rest of the year. But net for banks that have a balanced portfolio across products, which was, I guess, the whole point of the regulation post GFC, was to take away some of these extremities. It should be within that 5 to 10% down in range. But those banks that are more macro weighted, so typically the Europeans and some of the very largest US dealers, would probably do better than the ones that are more spread M&A equities heavy banks.
Interesting. Well, I guess hopefully we'll get some answers to some of our lingering questions over the next couple of months. Great. Good. Well, Michael, thank you for taking the time. Really interesting stuff. There's some data in the page below, so sort of click on the links if you have any questions. Of course, please always feel free to reach out to us. But Michael, thanks so much for taking the time today.
Thank you for having me.
Thank you.